Okay, let's unpack this. Welcome to the deep dive. We're here to cut through the noise, get straight to the insights you need. Today, we're diving into, well, the fascinating world of billionaire investors. Often complex, sometimes contradictory strategies. We'll look at two titans, Michael Platt, known for intricate macro trades, and the legend himself, Warren Buffett, champion of long-term value. Our mission: to explore a recent kind of surprising alignment between them, something focused on the simple yet powerful S&P 500 strategy. We're drawing from excerpts from Billionaire's Bet. Platt echoes Buffett's S&P 500 strategy.
Yeah, and it's really key to remember, not all these big investors move in lockstep. Not at all. We often see them heading in completely different directions, which, shows there's more than one way to win in the markets. I mean,
Right.
look at Stanley Druckenmiller, Duquesne family office. He recently sold all his NVIDIA shares.
Right.
But then Q1 2025, you've got Chase Coleman over at Tiger Global Management actually adding to his NVIDIA position.
Yeah, two totally opposite moves on the same stock.
Exactly. And both could easily be winning strategies, right?
Yeah.
Druckenmiller locks in huge gains. Coleman's maybe positioning for that next leg up. What's fascinating here is how often these, seemingly opposing strategies can both work out. Yet sometimes the sharpest minds land on the exact same powerful idea.
Okay, so let's bring in Michael Platt. This is where it gets really interesting. UK's wealthiest hedge fund manager, some say. Quite a force.
Oh, absolutely. Managing director of Blue Crest Capital Management. Huge operation. We're talking, $86 billion in assets under management?
That's the number. And Blue Crest, they co-founded it back in 2000. For nearly a decade now, it's been a private partnership, which means no outside investors, just focusing on their own capital.
Which gives them incredible flexibility, doesn't it?
It seems to have worked. Press reports mention a pretty stunning 38% gain last year. That was after a 20% return the year before. Impressive stuff.
Very impressive. And if we, connect this to the bigger picture, Platt's knack for seeing market shifts coming, it makes his recent moves really noteworthy. He has this amazing track record, strategic genius, really. Like back in 2007, he saw trouble brewing, sold Blue Crest's bank shares before the crash.
Yeah.
That was absolutely key to navigating the financial crisis.
Wow. Foresight like that is rare.
It is, and it's not just one-off calls. He's known for this macro-driven approach. He reads interest rates, currencies, credit markets, connects the dots globally. He diversifies across asset classes, not just to cut risk, but to actually capitalize on these big interconnected themes. It's complex, multi-layered thinking.
Okay, so he's known for complexity, for these aggressive, tactical macro trades, which makes this next part almost, surprising, doesn't it?
That's the puzzle piece, right? Why would someone like Platt, known for intricate plays, go for something as straightforward as a broad market S&P 500 ETF?
Exactly. What does that signal? More than just, I think the market's going up.
It's a great question, and maybe that's precisely why it stands out. For a manager like him, this kind of simple move, it could signal a really deep conviction. Perhaps it means that even with all the complexity, the best, most efficient bet right now is just the broad market itself. Almost a statement.
A statement indeed. So what was the move exactly? We know in Q1 2025, he bought shares of the SPDR S&P 500 ETF Trust, SPY, the ticker. It showed up as a new holding for him in his latest 13F filing. Those quarterly filings for managers handling over $100 million.
Right, the 13F's always a bit of a look in the rearview mirror, but still valuable.
Definitely. And it wasn't a small position. 117,163 shares, representing about 2.8% of his reported portfolio at the time. Significant.
Significant, yes. Especially for a new position in something so basic, comparatively.
Okay, so let's pivot. From Platt's tactical move to, the Oracle of Omaha, Warren Buffett. How does this all square with his philosophy?
Buffett. Well, his love for the S&P 500 index fund is legendary, isn't it?
It really is. It's not a new thing for him at all. He's held this exact ETF, SPY, in Berkshire's portfolio before. And maybe the most powerful endorsement, he's publicly stated, he instructed the trustee for his estate, that upon his death, most of the cash left to his wife should be put into a low-cost S&P 500 index fund.
That's commitment. And his reasoning is, it's classic Buffett. It's simple but profound. He loves these ETFs because they let anyone easily bet on, essentially, American business as a whole, the best U.S. companies. He deeply believes they deliver great returns over the long haul. He famously said something like, American business has done wonderfully over time and will continue to do so.
Though most assuredly, an unpredictable fits and starts.
Yeah,
I remember that quote.
that's the one.
Yeah.
And the SPDR S&P 500 fund, SPY, it's built to capture exactly that. It just mimics the index, holds the big names. And the index itself, it adjusts quarterly. Companies get added, dropped. As fortunes change, the ETF just follows suit, tracks the performance automatically.
It's always holding the leading companies of that moment, effectively.
Precisely. Which brings us back to that intriguing question.
Yeah.
Why are these two very different minds, Platt and Buffett, converging on something so simple?
It almost feels too easy, doesn't it? Like there should be a catch.
Maybe. Or maybe the genius is just recognizing the power of simplicity when everyone else is chasing complexity. It's kind of counterintuitive in finance, right? Complexity often gets rewarded, or at least seems more sophisticated.
True. So let's talk about that simplicity. What's the core benefit for you, the listener?
Right. The power here is accessibility. With just one purchase, like buying shares of SPY, you get exposure to hundreds of America's top companies, diversification instantly. And crucially, you don't need to constantly tinker. The index rebalances itself, as we said, so the ETF adjusts its holdings automatically. You're basically always invested in the current roster of leading businesses driving the economy.
So connecting it back to Platt, his buying this in Q1, it suggests he sees more upside for the whole market, right?
Yeah, that seems the most logical read, yes. Given his track record for calling market trends, you could definitely see it as a significant vote of confidence, a bet on American companies broadly.
And history does back up the long-term view, doesn't it?
It does. I mean, the S&P 500, it certainly has its down periods, regular corrections, even bear markets. But over the long run, it has always moved higher. The average annual return historically is around 10%. Obviously, past performance isn't future guarantee, but the trend is strong.
So what's fascinating here, as you said earlier, is that this simple Buffett-approved strategy, it's not just for billionaires.
Not at all. That's the key takeaway, I think. Platt, with all his resources and complex strategies, sees value here. But the same opportunity, essentially, is available to any individual investor. Buy and hold for the long haul. That's the mantra that seems to be echoed here, even by a trader like Platt dipping into this strategy.
So boiling it down for everyone listening, what's the main insight here, this unexpected overlap between Platt and Buffett on the S&P 500?
I think it shows that even the titans, the ones running incredibly complex operations, using sophisticated strategies, they still see fundamental value in straightforward long-term plays, like the S&P 500 ETF. It suggests that sometimes, maybe often, the simplest path, backed by the wisdom of giants like Buffett, can be incredibly powerful.
A good reminder that effective doesn't always mean complicated.
Exactly. Which does lead to perhaps a final thought to ponder. In this era of constant market noise, endless complex products being pushed, what other fundamental, maybe simple principles are we potentially overlooking? Principles that have consistently delivered long-term value and that the most successful investors have championed for decades. Something to think about.